Welcome, everybody. Good afternoon, good Friday afternoon, Friday, June 26th. Hope everybody is wonderful. We have a down day today, which is okay. Good to see everybody. All right, so what we're going to do is, first I'll tell you a little bit this new class we're starting, an 3-week options boot camp, and then we'll jump into the market and we'll talk a little bit calendars today. So first of all, the new class that we're going to be starting will be starting a week from Tuesday, July 17th. It'll run 3 weeks. Excuse me, July 7th, a week from this coming Tuesday, July 7th through 23, Tuesdays and Thursdays at 1 Central. It'll be a 3-week calendar boot camp. Be live trades at every class. Really going to work on that craft. You'll get slides and PowerPoints, how we do it each session. Everything will be archived like a typical Sheridan mentoring class. You have a Q&A button on there, so even if you're watching it recorded, you can watch it. But question is, why did I choose a 3-week calendar boot camp? Why am I doing this? Here's the reason. The calendar trade, when you normally think of a calendar trade, do you think of something you want to do in a low vol environment or high? What do you think? Low, right. But interesting, over the last 3.5 months in this high volatility environment, and really the last 3 months, the VIX has been between 25 and 40. We're in that upper end today. But this has been our most effective in Sheridan mentoring over the last 2.5 months, 3 months, 2.5 months, easy. It's been the most effective strategy. Who would think, right, that this strategy would be the most effective and best moneymaker? And so I thought it was important because it still is, even in the high vol environment, it's still very effective. And there's many reasons for that. But that's why I thought it was appropriate. I thought it could be helpful to people. It's still good, and I think it'll still continue for quite a while. But like anything else, it's becoming a good craftsman. So I'm excited about it. It'll be a 3-week boot camp. And Mark Fenton and Jay Bailey are both excellent calendar traders. Mark has, I think, spearheaded a lot of many of the techniques in the of the calendar over the last 3 months have been spearheaded by Mark. Jay's excellent at it. They're both tremendous calendar traders, and will have their input in this, what we're doing in the community. I think it'll be just, it's an easy strategy to learn in terms of there's only, you're buying and selling an option. And I think the fact that it'll be extremely practical. We'll be putting on every class, putting on a trade, following it to the end, and you'll see exactly how we do it. Whether you're a beginner or intermediate or advanced, you get a lot out of it. Even if you're advanced, my guess is you haven't been doing calendars like the way we've been doing it. I think we've made some very important tweaks to how we're doing it. And, we change things around, but I think it's working tremendously. And so this is something we want to share. I don't think it's an anomaly. I don't know if I could say that word, Georgia. Anomaly. I think it's a combination of things, Georgia. I don't think we took advantage of this as much in the past high volatility environment. Like in 2018 correction, we weren't doing these as much. And I think part of it, and I think part of it is Mark Fenton specifically, and I think some of the other veterans in the community, but I think spearheaded by Mark, we made some important tweaks to this thing. And I think as we've been putting these things on, we found that they really work. Now, again, there's some important tweaks with duration. There's important tweaks with the distance from the long to the short and how we change that like an accordion. But I think the biggest thing is just we're trading it differently. I don't think it's an anomaly. And I think that as we stay in a high vol environment, it'll be great, right? Now again, does that mean if you just slap something on like you think is a calendar, it's gonna? No, I mean that's why we're gonna spend 3 weeks and tell you and show you exactly how we're doing it. Again, that'll start a week from Tuesday. Jenny will have a banner up. It'll be 3 weeks, so it'll be $297. And it'll be just devoted to how we do these calendars, period. There'll be no other strategy. I did a calendar and fly class along with back spreads. I kind of put 3 strategies in one class some months back. We touched on it, but nowhere near enough, right? We kind of tried 3 strategies in one class. I do think this time the volatility is a little bit different, but it's still the same principles as far as high volatility in calendars. So anyways, that's the class. Again, we'll send something out. You can sign up on the front page, and that'll be starting a week from this Tuesday. So it'll be July 7th for minimum an hour each class. Live trades, extremely practical. Now, any questions on that, let me know. We will now jump into, as you can see, the SPX. So today, and what have you noticed here? Really, here's I think this is a 1 year, isn't it? 1 year price chart of SPX. And the only thing I have up here, I have a 200-day moving average, which is the green line. Here I have an 8-day, so you can see the 200-day moving average. It's interesting. This is like the second or third time in the last couple of weeks we bounced around that 200. Agree? So that's very interesting. We're still kind of range bound. Everybody, it just seems natural. We're going to continue to bounce off the 200 and go up. But, hey, can it go? How many people think, I'm just curious. A, I think we're going to bounce off this 200 next week and go up. B, I think we're going to go through it this time. What's your thoughts? A, I think we're going to bounce off the 200 next week. B, I think we're going through it. Wow, more Bs, right? Okay, so, and again, if I had again, as somebody said, I don't know which way we're going, but even though I don't know which way we're going, we still want to be aware of the weather conditions, right? And if you ask me where I would fit in, probably B, but it's only B, again, am I betting on a direction? No, not at all. But I think just because we're in the upper end of the range, we've been going up, since the last 3 months, we've been heading up. I think we're in the upper end of the range. And I think especially, again, as I've thought from the beginning, I think we're in a VIX 25 to 40 volatility range now. That's the, this correction environment kind of volatility range. And today we're closer to 35, kind of in the higher end of the range. That's how I kind of look at from a volatility and price. We're kind of in the upper end of the range here, right? From where we've been. And I think just, again, my 2 cents, and again, I don't know anything about what's going on, where the market will go, about the virus. I don't know. But if you ask me, do I think this is a typical correction? No, a typical correction would be like 2018. We were down 25%. In about 3 months, we were starting to unwind out of that. But because of what's going on in our economy and with COVID, I don't think it's a 3-monther. I think I've said from the beginning, I think it's closer to six, maybe 7, and it could go to 9 months, but 6 or 7. So I see this kind of high volatility range, 25 to 40. I see us staying there easily another 3 months. If you said to me on your VIX range of 25 to 40, do you think we have a better chance of going through 40 or 25? I'd say go through 40, right? I mean, we went under 25, 24 for a couple days, but I think where I think we could, in other words, I would bet somebody, I don't think in the next 2 months, we're going to stay under 25 more than a week or two, right? Or more than a week. But if you said, Dan, would you bet somebody that we're not going to go over 40? No, I wouldn't. I think we could go over, right? But again, I'm just looking for, for the income part of the portfolio, I'm looking for a range. Right now, we're still in that range until we bust the 200. And so today, in Sheridan Mentoring, we'll talk about the spec part of the portfolio, what kind of trades there. That would be, I have an opinion, whether you buy a call or a put, or you buy a vertical, or you do a call credit spread or put credit spread in the spec, that spec. And we have a certain amount of dollars you might allocate towards that. The long part of the portfolio, which would be the view of an investor neutral to bullish, covered writes, cash secured puts, put credit spreads, long diagonals, long stock. For that part of an intentional part of a portfolio, today I might do something, right? Or not might, I would, right? Because if I had, from an investor point of the, what's an investing, your long portfolio will be the view of an investor, neutral to bullish. Do you like days like this? If you're a long-term investor and you like stocks yesterday, should you, if you're of sound mind and body, like them better today? Yes or no? If you liked XYZ stock yesterday, should you like XYZ stock better today if you're a long-term investor? Absolutely. Yes, the answer is yes. If you have an intentional, if you liked XYZ yesterday, should you like it today lower? If you're a long-term, let me say that in English, Spanish, and Swahili, a long-term investor. Go, long-term investor. But most of you thinking for the long portfolio, are most of you thinking long portfolio? Are you thinking spec? Where are we going in a week? Spec. Where are we going tomorrow? Spec. Where are we going in 2 weeks? Spec. Yeah, I'm not talking about that right now. Long portfolio is view of an investor. Capiche? Capiche. So with the range here a little higher, it's a little higher for calendars right now. It doesn't mean I wouldn't do them, but it's a little higher. So let's just give an example of a calendar and talk calendars just so we see what we're up against. How many of you do calendars on a regular basis? How many of you do calendars on a regular basis? Some? Okay. So let's just go over an example of a calendar. So here's July 10. This is one example of one. July 10, 14 days out. And let's just talk calendars for a few minutes here. So we're going to look just for one example today, a 14-day calendar. And we're going to buy our long 1 week out in this example, July 17. So here's our example. So what are we doing? We're buying one July 17, 30-25 call. And against that, we're going to sell one July 10, 3025 call. So this is a 14-day calendar, meaning our short expires in 14 days. Our long will expire in 21 days. So we call it, the way you label these calendars is by the short. So this is 14 days to go July 2. So it's a 14-day calendar. And it's going for this particular calendar, right? We can get them cheaper. But it's going for roughly, I'll freeze it here, around $14 and let's just call it 80 cents, this particular one, right? So cash wise, this particular one, right? And we do calendars for 500, 600, different, but we would go over that. So let's talk about how a calendar makes money, and then we'll talk about the Greeks a little bit. So we're putting a calendar on at the money. And so we're buying one July 17, 3025 call, selling one July 10, 3025 call. So if you look at the graph of a calendar, this is the expiration in 14 days, the green graph. The purple graph, that's your position today, T+0 graph. So as a trader, do we want to, as a trader, are we more concerned with managing a calendar by how the graph looks today, A, or how the graph looks at expiration, B? Where's our focus more on? A, the T+0 curve. Yeah, today's graph. Now, over the next 2 weeks, this graph will morph into this, right? And yes, we'll talk some directional calendars also during class. Yes. And again, there's nothing we won't cover, but the key, let's face it, most of you, how many of you would be thrilled if you got good at one strategy and you could make some, one strategy that you could look to make X amount a week or a month? That's what we're trying to focus on, is a strategy that a lot of people are having success with in the community and spending 3 weeks on it. But again, here's the reality. This is a craft. If you think that in 3 weeks you're going to be an expert, you need to immediately leave this webinar, go to the airport with your mask, get a ticket to Magic Kingdom, I don't know if it's open, and tell them Dan sent you, because that's where, because you said that you're going to be an expert in 3 weeks on a calendar and you expect to make $5,000 a week on a calendar. That's where you need to go, right? That's where you need to be, right? This is a stinking craft, right? Right? Do we have students that are making good money on this? A very good return. Many, yes. They're craftsmen, right? They're craftsmen. What does that mean in English or German? See, German, I think I can make it clear. In German, what that means is they're putting this on, they've put 20 or 30 or 35 of these on the right way. They're becoming a craftsman. They're getting better. For those people, they're looking to make 3 to 5% a week, right, on these things. Now, if you said to me, hey, Dan, after 3 weeks, can I expect to make 3 to 5%? Here would be my response, right? If you got lucky and the market didn't move, but I'd sure hate to base a business on luck. Wouldn't you? Wouldn't you? Wouldn't you hate to base a business on luck? And so again, this is a craft. Anyways, so when you put it on at 30.25, how do you make money? Why on a $1,480 investment how in the world is there a possibility you could make $3,000? How the heck is there the possibility on a $1,400 investment that you could make $3,000, which would be a lot of money? Agree? How is that possible? Well, is that probable that you'll make this amount of money? Is that probable? No. Do you remember my bad analogy? I don't know if I remember. There was a movie that Lou Alcindor, Kareem Abdul-Jabbar was in, the karate movie. And in this movie with, I think, Chuck Norris or Bruce Lee or one of these guys, and you had these different levels, right? Right? And you get to this level and this level and this level and this. Well, the problem, to make all this money, right? What needs to happen? How do you make money in a calendar? What they're assuming, if we close right at the strike, the short strike, what you sold the 30/25s for goes to zero. And this still, because it would have a week to go, will hold a lot of value, right? Will hold a lot of value. This could be trading at $22 with a week to go, and at the money, 3,025 strikes. So when you pay $14.80, if it were to close at the short strike at expiration, the spread expands. It would go from $14.80 to $22 or whatever. But the point is, that's how it makes money at expiration, or over time, the short's going to decay a lot quicker than the long will, right? I mean, that's the basics of it. And so, I mean, a calendar in a high vol environment, what makes it special is your expiration break evens are wide out here. You're routinely getting 100 points away from the each side before the trade gets in trouble on these calendars. And that's a benefit in a high vol environment that you don't get in a low vol environment. But the struggle with these calendars is you've got some volatility risk, because when you're buying a further out option, you're buying this option, the July 17, has a lot more extrinsic value in it than the one you're selling July 10, right? Let me just for a second, I think it's better when we can put some prices to these things. Give me a second. Let me just write. Sometimes it's better to get some actual prices. July 17, 30, 20. Let's move, because the market's going down. So I'm going to move this to the 30-20 strike, because we're at 30.19. So at the money would be 30.20. So let me write this down, because I think it's better when you can see. To get under the hood of a calendar, it's good to see the actual prices. The July 17, especially on a $3,000 vehicle, the July 17 30-20 call, our long, is going for about 85 bucks. Do you see that? That's a big number. Who would have thought an at the money, did you guys know that? An at the money 21-day option and SPX is going for $85. Does that surprise anybody? That's a big number, isn't it? That's a big number. Well, yeah, Dino trades a lot, but for most of you, that's a big number. The July 10s, the one we're selling, the 30-20s, the July 10s, the 30-20s, they're trading at about 69 bucks. So now let's put some faces to what we're talking about. Now we're looking to buy one July 17 30-20 call for, again, the spread's trading for around 15 bucks. So let's just say our long would be around $85. And we're going to sell one July 10, 30/20 call. Let's say 70 bucks. So you're paying $15 debit. You see that? Roughly. And so, if you look at, so what it's saying at expiration, if we close right at the strike, 30/20, what you sold 70, what's that going for? If we close at 30/20 in 14 days, what is this going for? We sold the short for $70. And in 2 weeks, if we close at 30/20, what's that going to? 0. So how much did you make on one short call? How much did you make on one short call? How much did you make on one short call? Keep going. I got a 70 and a 700. Keep going. No one's got it yet. If I sell the July 10, 30/20 call for $70 at expiration in 14 days at 30/20, it goes to 0. How much did I make? $7,000 on my short call. Is that clear? 70 would be 7 grand, right? That's a lot of cicadas, right? Now, the question is, in 7 days, right? Again, we're paying about 15 for this. In 7 days, with 7 days to go on July 10 expiration, take a guess what this puppy's going to be worth. What's that guy going to be worth at 7 days to expiration? So the July 17, 30/20 calls on July 10th with 1 week to go, what's it going to be worth? Dino or somebody, do me a favor. You know what the answer is? Here's the answer. Don't tell anybody. What's the price of a 7 day? So what am I asking? What is the July 17 going to be worth when it has 7 days to go? Here's a secret. Look at an option right now. Someone find me next Friday expiration option. And what's the at the money call going for? What's the at the money call going for on a 7-day option right now? All right, what's the at the money call? So 7 days would be 50. Is that right? Is that correct? Yes, about 50. Okay. So all I asked was, look at next Friday's expiration, look at an at the money call. And someone told me it's 50. Is that correct? So if it's 50, all right, so it shows you how much things decay in that last week. Is that right? The spread goes from $15 to 50. Wowzay. Right, Friday's close. Thank you, Petra. But generally, this is the story. So how much do we make on that trade? If we bought it at 15 and sold it at 50, how much? Now again, yeah, next week's July 4th, but at least we're just trying to put some faces to this thing. How much do we make? If you bought something at $1,500 and you sold it at $5 grand, you make $3,500. Well, so now you're getting, does that give you guys an idea how if we close at the short strike, we're making about $3,500? Does that hit you guys? Yes, no? Does that give you a clear visual how this thing works? Right? And so you can see that might seem a lot, right? Right? This right today has 21 days to go. Maybe you'd think, it should go to 40. But why did it go to 50? It's just that last week things really expire, don't they? Or really decay that last week. So that's why a calendar makes so much money at expiration. Now, we don't trade it like that, right? Because, I don't think we can make a living betting every week that we're going to close at the short strike. Ain't going to happen. Probabilities are, what's an expected move or a standard deviation? If this is a 14-day trade, what's the expected move? Maybe someone could help me out there. If you look at Thinkorswim, what's the expected move or standard deviation for 14 days, the length of this trade? So what's an expected move? So in other words, look at the July 10 expiration. That's 14 days, right? For the July 10 expiration, what do they give you for an expected move? For the July 10 expiration, what's an expected move? Okay, so 165 points. And that's just a standard deviation. That's what it is. Right? So they're saying there's a 65% chance, a 68% chance that over the next 2 weeks, we're going to be plus or minus 165 points. So let me ask you a question. If our expiration break evens are around 100 points in this where we make money, and the expected move is 165 points, does that bode well for this trade? If our break evens are about 100 points, but the expected move is 165, does that bode well for this trade? Somebody say no, so we can move on. No, right? So the bottom line is what we're going to cover in the class is what's important in trading these calendars. A, do we stay in them the entire, this is a 14-day trade, do we stay in them the entire 14 days? Absolutely not. Do we stay in much less than the 14 days? Yes. Is it important to look at the VIX range when we're putting on a calendar? Yes. Is it really important, the distance between your long option and your short? Yes. There's a lot of crucial elements. Is it important to be aware of the range of SPX and when you're doing calendars? Yes. Do you think this is good if we look at the chart? If you look at these candles, right? Price move, this is a 6-month price chart, but this is, have we been getting more 1 to 2% moves more in the last 2 weeks? Yes or no? Yeah, we have. Now, has it adversely affected calendar traders? Not a lot. Some, because why? Why hasn't the wider moves, right? And again, these candles as these price candles are getting bigger, just saying the distance from the high to the low each day get bigger. But why do you think that hasn't in the last few weeks affected the profitability of calendars? Why do you think? Yes, you get more room, but look at the market. Has this been a range? Yes or no? Has that been a range? Yeah. What do you want? We want some type of a range. most of the last 3 months, we've had some type of a range. Was this the initial move or range? Yes or no? No. So there's a lot of things, some basic things you have to look at, right? In calendar traders. And that's it. And that's what we're going to focus on in the next week when we start the next 3 weeks when we do this class, starting a week from Tuesday, which will be July 7th, is what do you got to know? When do we put these on? When don't we put them on? Which strike do we sell? What do we buy? Which duration? And then the risk management. Where do we take it off for a profit, a loss? When do we adjust? And I think a lot of the tweaks, I think a lot of these are newer. That a lot of the way we've traded calendars the last 3 months, we weren't trading 6 months ago. First of all, we weren't trading this high vol. So I think it'll be we're really going to delve under the hood, right? And so if you're looking for a strategy that you can make your own, one good strategy, I think this would be a good opportunity for you, because there's going to be an opportunity to work on this repetition over and over and over. So that's at least a little bit of an intro into this course. We look forward to it. And again, you're gaining the benefit in this course of many of the true craftsmen in the Sheridan community that have helped make this strategy better. Dino and many of the others, and then especially some of the mentors, Mark, Jay Bailey, and Mark, big time over the last 3 months. And a lot of this, and you're benefiting from this input, so that when you go in, you won't have to make as many mistakes. But again, it's still a craft. This is not a get rich quick. And again, that's what we're trying to teach you as a craft. So anyways, thanks everybody. Have a wonderful weekend. And we will see you a week from Tuesday in the calendar boot camp. Have a nice day. Thanks.